What is a Treasury bond and what is a Treasury yield? And why do Treasuries impact our interest rates? And why do they have such a huge impact on the stock market, particularly the high growth tech names that we all love? Have you ever thought about any of these things, but everything you read or watch about them doesn't quite make sense? Well, if that's the case, then this is the video for you. Now, whether you're an aspiring investor or you just want a better understanding of how the financial system works, understanding what treasuries are and how they impact the economy and our daily lives is essential. I don't mean this in a bad way, but so much of the content out there literally puts me to sleep and only makes things more confusing. Now, I'm not selling anything and I'm not pitching any product. I made this video with the genuine intent of spreading knowledge that, in my opinion, everyone in America and the world should know. Understanding how treasuries work and what they are will give you a much better picture of the broader economy and will make you a much better investor in the long term. Now, I didn't create this channel to talk about get-rich-quick schemes and other high-risk investments. Now, one of the reasons I started this channel was to help people understand the capital markets better so that they could use this knowledge to help them manage their money and build long-term wealth. As much as people like to think that the stock market is some rigged game that only benefits a select few, it's not. If it was, every retirement plan in the world wouldn't be invested in it. And to be honest, it's something that every person should understand because it impacts all of our lives in one way or another. Almost every asset and financial product on the planet, from real estate to the domestic and international stock market, the bond market, and the interest rates we pay on our mortgages, our student loans, and our credit cards are all impacted by treasuries. So I need you to watch this video until the end because I'm going to be dropping some serious knowledge. A treasury is simply a government bond, and a bond can be thought of as a way of lending or borrowing money similar to an IOU. Corporations or governments will give investors like you and me the opportunity to lend them money, and they will pay us back plus interest. United States Treasury securities, aka Treasuries, are just government bonds issued by the United States Department of Treasury to finance government spending as an alternative to taxation. So when anyone, whether it's an institutional investor or a retail investor like me, buys a treasury, we are simply loaning money to the government and the government will pay us back plus interest. Now, in the world of finance, U.S. treasuries are as close to risk-free as an investment can get. The interest rate that's paid to us is simply determined by supply and demand. Now, all treasuries are sold at an auction where the market dictates how much these bonds pay out. The government holds this auction and pretty much says, hey, who wants to loan us money for 1 year? And after that 1 year, I'll give you, let's say, $1,000. Now, since it's an auction, some investors may be willing to pay $900, some may be willing to pay $950, and some may be willing to pay $980. For this example, let's say that I buy a treasury for $950 and the government issues me this security, which is a U.S. treasury that will pay $1,000 in 1 year's time. Now, fast forward 1 year, and what happens? Well, the terms of our 1 year government treasury states that the holder of this security will get $1,000 from the U.S. government. Now, when we look at the money flows, it's pretty clear that I gave the government $950, and a year later, they gave me $1,000. Now, if we put this in terms of interest or yield, I lent $950 and I got back $1,000. So in order to calculate the interest or yield, we simply divide 1,000 by 950 and we get 1.0526. And if we move the decimal point over 2 spots, we can calculate that we got a 5.26% interest rate. Not only did I get my initial money back, the $950, I also made $50 in interest, which is an interest rate or yield of 5.26%. Now, let's say that demand for this 1 year treasury security that's yielding 5.26% surges. Well, we all know that when demand increases, prices tend to increase as well. So let's say that now the price of this 1 year treasury security is no longer $950. Demand has pushed the price up to $980. Now, to calculate the interest rate or the yield, we would follow the same process. Only now we would divide $980 by $1,000. When we do that, we get 1.0204, and if we move the decimal point over 2 spots, we have an interest rate or yield of 2.04%. So to quickly recap, at the $980 price for the Treasury security, we are essentially lending the government money and making 2.04% annual interest or yield. And at the $950 price for the Treasury, we are lending the government money at an annual interest or yield of 5.26%. Now, the reason I'm showing you this is because as the price of the bond or Treasury security increases, the yield or interest on the Treasury security decreases. So if the demand or price of the Treasury security goes up, the amount of money that it pays, aka the yield, goes down. The price and the yield have an inverse relationship. So now when you hear the term 10-year yield or 30-year yield being discussed on TV or in the newspaper or on the internet, you'll know exactly what it means. And just really quickly, Treasury securities are often referred to as Treasury bills or Treasury notes and Treasury bonds. And the only difference between bills, notes, and bonds is duration. Treasury bills are issued in maturities of 4 weeks, 8 weeks, 13 weeks, 26 weeks, and 52 weeks. Treasury notes are issued in maturities of 2 years, 3 years, 5 years, 7 years, and 10 years. Last, we have Treasury bonds, which are issued in a 20-year maturity and a 30-year maturity. Now, let's get to the part that you've all been waiting for. Now, these days, when Treasury rates or yields rise, stocks fall. And that's because rising rates ripple through the economy. I mean, everything from our mortgage rates, our corporate debt rates, our student loan rates, our auto loan rates, and our credit card rates are all tied to Treasuries. Now, as many of you may have heard, inflation is expected to rise in the near term to well above 2% due to the rapid reopening of the economy. And with this expected rise in inflation, U.S. Treasuries like the 10-year note look less and less attractive as they currently offer a 1.6% yield. Now, I hope that makes sense. Essentially, if inflation is expected to deteriorate a dollar by more than 2% a year, why would you invest in something like a 10-year Treasury that only makes you or yields 1.6% a year? As you can imagine, at 1.6%, the demand for this Treasury security decreases, so the price of it gets lower and lower and lower. And as we discussed earlier in this video, when bond prices go down, their yield goes up, and that's what we're seeing with Treasuries right now. If we look at a 1-year chart, you can see that yields on the 10-year Treasury have been increasing at a rapid rate. And when the yield on the 10-year and 30-year Treasury go up, interest rates on every type of debt obligation go up as well. So everything from our mortgage rates to our auto loan rates to our credit card interest rates and our student loan interest rates and even our corporate debt rates go up. Literally everything goes up. Now you might be thinking, how does this impact the stock market? Well, let me explain. All stocks, but particularly growth stocks and high-flying tech stocks, are very price sensitive to any change in Treasury yields. And that can mainly be attributed to the fact that these companies are mainly valued on their future growth potential. Now, in general, these stocks generally have high prices relative to earnings and are expected to make a majority of their profit in the future. So when interest rates are low, as they have been, these companies can borrow money at attractive rates to help with growth or investment in the business. But when interest rates increase, their borrowing costs go up as well, which in turn hurts their future profit margins, which in turn has a negative impact on their stock price. And it has a particularly negative impact on growth stocks and young companies who are expected to make a bulk of their profit or revenue in the future. Now, I hope that all made sense. But to recap, Treasury yields are expected to return less than inflation. Now that's causing the price of Treasuries to go down. And when their price goes down, their yield goes up. And when Treasury yields go up, so do interest rates on everything else, including mortgages, credit card debt, student loan obligations, and corporate debt. When rates on corporate debt increase, margins decrease. And when margins decrease, companies' values decrease, and that's why stocks go down. Now, the companies most impacted by this are companies that expect a bulk of their revenue to be generated in the future. And that's why we've been seeing these high-flying and young tech stocks get hammered over the past month or so. Treasury securities are backed by the full faith and credit of the United States, meaning that the government promises to raise money by any legally available means to repay them. The United States has a strong record of repayment that has given Treasury securities a reputation as the world's lowest risk investment. And that's the reason there is over $28 trillion in outstanding Treasuries, aka debt the United States government owes. Now, I'd love to get into that today, but we can cover this in a separate video. I know that for many of us, treasuries and understanding their corresponding interest rates or yield can be pretty confusing, so I hope that this video was helpful. I tried to simplify it in a way so that most people could understand how treasuries work and how they impact almost every sector of the financial market. Like I said earlier in this video, I make these videos to spread knowledge so that you, the viewer, have a better understanding of how the financial system works. The more you know, the more comfortable you will be investing your money. And I'm a firm believer that long-term investing is the key to financial independence. On that note, I hope you guys learned something new today. I'll see you all next time.
I've been around the world, I've seen a million girls, but no matter what I do, ain't nobody like you, like. I've been around the world, I've seen a million girls, but no matter what I do, ain't nobody like you, like. Hey yo, check the philosophy, she always makes time for me, love so good, man.